Bitcoin's price looks stable, but the market's heartbeat underneath is accelerating. Institutional inflows are quietly returning. Whales are moving billions on-chain, and liquidity is shifting in a way we haven't seen since early summer. Welcome to Cryptoscope AI, where we decode the market using data, not noise, not hype. Today we're digging into the latest ETF flows, whale behavior, and on-chain liquidity that are shaping Bitcoin's next major move. Let's start with the numbers that actually matter. According to new reports from BlackRock, Fidelity, and CoinShares, crypto ETPs recorded $3.17 billion in net inflows last week, despite the global market pullback. That's one of the strongest inflow readings of the quarter. Bitcoin ETFs alone accounted for roughly $2.3 billion, while Ethereum products attracted another $400 million. These aren't retail investors chasing pumps. This is institutional capital deliberately positioning into weakness. Historically, when ETF inflows turn positive for 2 consecutive weeks after a drawdown, Bitcoin delivers an average 8 to 12% upward move within the next 3 trading sessions. The message is clear. While social media screams fear, institutional desks are quietly buying exposure. On-chain behavior confirms that story. The number of wallets holding more than 1,000 BTC has risen for 4 days in a row, the longest accumulation streak since May. Exchange reserves, on the other hand, just hit a 3-month low. When coins leave exchanges, it's a signal that holders are moving to cold storage, removing sell pressure from the market. Funding rates across major perpetual futures flipped from positive to slightly negative, meaning excessive leverage got flushed out. That's healthy. The market is now balanced, not overheated, not overly short. It's the kind of environment where real momentum can build without liquidation risk killing it early. Technically, Bitcoin is coiling inside a tightening range between $110,000 support and $125,000 resistance. The 50-day EMA sits near $117,800, serving as a pivot point, and whichever side breaks this zone first will control the next 10K move. RSI has cooled from 76 down to 52. That's a textbook mid-trend reset. MACD histogram is curling upward toward the zero line, often the start of fresh momentum. Volume profile data shows 2 major liquidity nodes, one around $111K, where buyers stepped in during the last dip, and another near $124K, where short-term traders took profits. A clean daily close above $125K with volume confirmation opens the path toward $132K to $135K, the next resistance cluster. But if $110K fails under heavy volume, the market could quickly retest the psychological $100K zone before any recovery. Here's how the next 72 hours line up. Bullish trigger. Another day of strong ETF inflows plus a daily candle above $125K. Gas. Confirmation of renewed institutional momentum. Neutral zone. Sideways between $112K, $124K, while funding stays near zero. Ours healthy consolidation. Bearish trigger. Rising exchange inflows. Plus negative funding plus a close below $110K momentum breakdown. What's important isn't guessing direction. It's tracking data alignment. When ETF flows, whale accumulation and neutral funding converge, volatility follows, and usually in the direction of those inflows. So while the headlines chase yesterday's price, the data already paints tomorrow's move. Institutional money is quietly setting up. The only question is whether retail will notice before the breakout. You're watching Cryptoscope AI, real-time crypto insights powered by data, driven by logic, not hype. Stay sharp, stay analytical, and remember, this is not financial advice.